Hello everyone and welcome to the third webcast on the second comprehensive review of the IFRS for SMEs Standard. My name is Yousouf Hansye and I'm joined by Wenyi Zheng. We are both members of the IASB technical staff. Before we start, a quick update on topics covered in previous webcasts. In our first webcast, we reviewed the IFRS for SMEs Standard, its use around the world, why the board has developed it, and introduced the second comprehensive review. The second webcast looked at how the board has approached this comprehensive review. We focused on part A of the requests for information, strategic and general questions, including the alignment principles and how the board has applied these principles in considering how to align the IFRS for SMEs standard by demonstrating their application to IFRS 3 Business Combinations 2008 and IFRS 16 Leases. In this webcast, we will look in more detail at those IFRS standards which the IFRS for SMEs standard is not currently aligned with. These include IFRS 10, Consolidated Financial Statements, IFRS 11, Joint Arrangement, IFRS 9, Financial Instruments, IFRS 15, Revenue for Contracts with Customers, IFRS 13, Fair Value Measurement, and IFRS 14, Regulatory Deferral Accounts. At the end of this webcast, we will explain how you can get involved in the second comprehensive review. Finally, just to let you know that in August, we plan to hold a webinar to provide you with the opportunity to ask us questions on all aspects of the second comprehensive review. Before we start, just a couple of housekeeping items. The request for information, the optional response document, and the online survey can be accessed on our website. You can find a link to the project webpage on the slide. In addition, you can find a link to access the slides that we will be using in this webcast, including the slides for the first and second webcast. The views expressed in today's webcast are those of Wenyi and myself and do not necessarily reflect those of the board or the IFRS Foundation. Let's begin with a quick recap of the board's approach to this review that we discussed in the second webcast. In developing the IFRS for SMEs standard, the board considered two approaches: a simplified IFRS standard or develop an independent standard. The board adopted the first approach based on feedback to its discussion paper. In this second comprehensive review, the board is seeking views on whether the IFRS for SMEs standard should remain aligned with IFRS standards. Not updating the IFRS for SMEs standards for developments in IFRS standards would see it diverge from IFRS standards and become over time an independent standard. The board approached this second comprehensive review on the assumption that the IFRS for SMEs standard should remain aligned with IFRS standards. In seeking information on how to align the IFRS for SMEs standard with new and amended IFRS standards, the board has applied three principles. The objective of the principles is to help the board develop amendments to the IFRS for SMEs standard that are suitable for SMEs whilst maintaining a balance of cost and benefit. The principles are: relevance, which considers whether the problem addressed by an IFRS standard would make a difference to the decisions of users of financial statements prepared applying the IFRS for SMEs standard. Simplification involves looking at IFRS standards that have satisfied the relevance principle and assessing what simplifications are appropriate. And finally, faithful representation is intended to help the board assess whether financial statements prepared applying the IFRS for SMEs standard would faithfully represent the substance of economic phenomena in words and numbers. Let's now look at how the board has applied these alignment principles to IFRS 10, Consolidated Financial Statements, and IFRS 11, Joint Arrangements. Applying the principle of relevance, the board noted that it had previously assessed considered financial statements to be relevant for SMEs and therefore decided the question it needed to address was whether improvements introduced by IFRS 10 would be relevant to users of SMEs financial statements and or assist preparers of financial statements. Before IFRS 10 was introduced, IFRS adopters used one of two tests to determine whether or not to consolidate an entity. A control test was used for the more conventional holding investor-investee relationships, while a different, more rules-based was applied when business was conducted through a special purpose entity. IFRS 10 combined these two tests into a single control-based approach and provided robust guidance to help an entity assess control. The board considered that this approach would be simpler to apply and simpler to understand. The IFRS for SMEs Standard currently includes requirements similar to those that existed in full IFRS standards before IFRS 10 was introduced. The board therefore decided whether introducing the single basis for consolidation would also ease application and understanding of the IFRS for SMEs standard. Section 9 includes a further simplification, a rebuttable presumption that the parent has control when it directly or indirectly owns more than half of the voting rights. This simplification assists entities applying the IFRS for SMEs standard that control another entity directly through voting rights, as such entities do not need to perform a complex review of other elements of the definition of control. The board noted that the rebuttable presumption in Section 9 simplifies the requirements in IFRS standards and that the argument for including this simplification in the IFRS for SMEs standard has not changed. Thus, the board is seeking views on retaining this simplification should the board propose to align the definition of control in Section 9 with IFRS 10. In assessing faithful representation, the board considered whether a single basis for consolidation with the proposed simplification would provide information that faithfully represents investees in which investors have control and that is useful to users of financial statements prepared applying the IFRS for SMEs standard. The board considered that this will not lead to an entity to represent information less faithfully. An entity that owns more than 50% of the voting rights but does not believe it has control can rebut the presumption. Moving on to IFRS 11, joint arrangements. Firstly, as it had done for IFRS 10, the board noted that it had already assessed accounting for investments in joint arrangements to be relevant for entities applying the IFRS for SMEs standard. Furthermore, the board noted that the definition of joint control in IFRS 11 is linked to the definition of control in IFRS 10. Having decided to seek views on aligning the IFRS for SMEs standard with IFRS 10, the board decided to also seek views on alignment with IFRS 11. In applying the simplification principle, the board took into consideration the feedback that IFRS 11 had been challenging for entities to apply in practice, specifically in deciding how to classify a joint arrangement as either a joint operation or a joint venture. The board noted that it could align the definition of joint control without changing the categories of joint arrangement in Section 15. It is therefore seeking views on aligning the definition of joint control whilst retaining the existing categories of joint arrangement, namely jointly controlled operations, jointly controlled assets, and jointly controlled entities. In the IFRS for SMEs standard, Section 15 permits an entity to account for its interest in jointly controlled entities using the cost model, the equity method, or the fair value model. In contrast, IFRS 11 requires the equity methods for joint ventures. The accounting policy election for jointly controlled entities was introduced when the board developed the IFRS for SMEs standard because SMEs experience difficulty applying the equity method and because fair values are relevant for lenders. It was therefore a simplification. The board does not have any evidence that this circumstance has changed and is seeking views on retaining the accounting policy election. When considering faithful representation, the board decided that aligning only the definition of joint control whilst retaining the three types of joint ventures or arrangements and the corresponding accounting requirements in Section 15 would not impede faithful representations of joint arrangements. Moving on to the next standard, in considering how the IFRS for SMEs standard should be aligned with IFRS 9, the board assessed the IFRS 9 topics individually for classification and measurement of financial assets, financial liabilities and own credit risk, impairment and hedge accounting. Applying the relevance principle, the board decided that some IFRS 9 topics are unlikely to be relevant to entities applying the IFRS for SMEs standard and decided not to include them in the second comprehensive review. These topics include financial liabilities and own credit risk, disclosures required by IFRS 7 financial instruments disclosures when an entity elects to follow IAS 39 instead of the financial instruments sections of the IFRS for SMEs standard. The board considered that the decision to exempt an entity from these disclosures made when the IFRS for SMEs standard was developed still applies. Similarly, the board noted that requirements for derecognition of financial assets and financial liabilities were carried forward unchanged from IAS 39 to IFRS 9. Section 11 includes simplified derecognition principles based on IAS 39. Consequently, the board decided it did not need to include this topic in the second comprehensive review. For the classification of financial assets, the board considered that it could ease application of the standard by supplementing the list of examples in Section 11 with a principle based on the financial assets' contractual cash flow characteristics. The supplementary principle would provide a clear rationale for classifying financial assets and thereby measuring them either at amortized cost or fair value when the characteristics of a financial asset do not match any of the examples in Section 11. The board identified two simplifications for the classification and measurement of financial assets. First, removing the requirement to determine how financial assets should be classified and measured on the basis of the entity's business model for managing the financial asset. And second, removing the option to present in other comprehensive income subsequent changes in the fair value of an investment in an equity instrument. The board concluded that faithful representation is still achieved by removing the business model assessment because it is unlikely to significantly impact the classification of financial assets held by entities applying the IFRS for SMEs standard. For impairment, the board noted the expected credit loss impairment model of IFRS 9 provides better quality and more relevant information for users of financial statements than the incurred loss model of the IFRS for SMEs standard. The board considered the benefits of only requiring the IFRS 9 simplified approach for trade receivables, contract assets, and lease receivables, known as the simplified approach. The simplified approach requires the loss allowance to be measured at an amount equal to lifetime expected credit losses. Therefore, the simplified approach alleviates the practical concerns about using the general approach for tracking changes in credit risk to determine whether there has been a significant increase in credit risk. Given the scope of the IFRS for SMEs standard, that is, entities that do not have public accountability, the board concluded that it would be appropriate to only require the simplified method. When assessing faithful representation, the board observed the simplified approach provides more useful and relevant information than the incurred loss model, and it provides faithful representation. When applying the relevance principle to the hedge accounting requirements, the board noted that Section 12 focuses on the types of hedging that SMEs are likely to use and only allows hedge accounting for particular risk. Furthermore, the board noted that Section 12 hedging requirement is well understood and accepted by users and preparers of financial statements prepared applying the IFRS for SMEs standard. The board decided to seek views on the need for Section 12 to provide hedge accounting requirements and to seek views on retaining the current requirements rather than aligning with IFRS 9. I am now going to hand over to Wenyi, who will discuss the other IFRS standards and what the board is seeking views on in the request for information.
Thank you, Yousouf. When applying the principle of relevance to IFRS 15, revenue from contracts with customers, the board noted that revenue is as relevant to SME as it is to entities applying IFRS standards. IFRS 15 replaced the previous revenue standard, IAS 18 revenue and IAS 11 construction contracts. The standard introduced a common and more robust framework for recognizing revenue, as well as providing guidance for more complex revenue transactions. The board observed that the revenue sections in IFRS for SME Standard already achieved many of the outcomes introduced by IFRS 15, and particularly noted that the guidance for more complex transactions may not be relevant for the simple transaction typically entered into by SMEs. However, the board also noted that given the importance of revenue in financial statements, any misalignment may have a disproportionate negative impact on understanding. The board identifies three possible approaches to aligning Section 23 with IFRS 15. Alternative 1 would involve modifying Section 23 only to remove the clear differences in outcome from applying Section 23 or IFRS 15, without wholly reworking Section 23. For example, the current guidance of Section 23 will be revoked, so it relates to the timing of the satisfaction of performance obligations and the distinction between performance over the time and at a point in time. Alternative 2 would fully rewrite Section 23 to reflect the principles and language used in IFRS 15. Alternative 3 is not to make amendment to Section 23 as part of the second comprehensive review. The board also discussed whether to provide transitional reliefs if Alternative 1 or Alternative 2 is chosen, by permitting an entity to continue its current revenue recognition policy for any contracts already in progress at the transaction date or scheduled to be complete within a set time after the transaction date. When assessing favor representation, the board noted both Alternative 1 or 2 would align the IFRS for SME Standard with IFRS 15. If no changes are proposed to Section 23 for alignment with IFRS 15, users would not benefit. As part of this comprehensive review, from the new approach which the board has concluded results in better information that more faithfully represents a reporting entity's performance. Change will be merited if the benefits of alignment outweigh the cost of the change, despite the outcomes will not be changing significantly. On this slide, we consider other IFRS standards the board considered in discussing alignment. The first of these is IFRS 13, Fair Value Measurement. When considering relevance, the board noted the IFRS for SME Standard already requires the use of fair value measurement, but similar to IFRS Standard before IFRS 13. Guidance on using fair value is scattered throughout the IFRS for SME Standard. The board concluded that providing centrally located, consistent guidance on applying fair value would be relevant for SMEs. Applying the principle of simplicity, the board considered the IFRS 13 definition of fair value is clearer than the IFRS 4 SME Standard definition of fair value, and therefore simpler to apply. A clear definition that is simple to apply without changing the requirements of when to measure an asset or liability at fair value support the faithful representation principle. Moving on to the last IFRS standard in this webcast, IFRS 14, Regulatory Deferral Accounts. The board acknowledged that entities subject to rate regulation may be in the scope of the IFRS for SME Standard, and hence the topic may be relevant. However, the board decided to seek views on not aligning the IFRS for SME Standard with IFRS 14, because IFRS 14 may be replaced by an active standard setting project. Finally, the board has applied the alignment principles to each amendment to IFRS Standard and IFRIC interpretation to decide whether to seek views on aligning the IFRS for SME Standard, seek views on leaving the IFRS for SME Standard unchanged, that is, on not aligning, or request further information on whether to align the IFRS for SME Standard. More information about the board's rationale for each amendment to IFRS Standard and IFRIC interpretation can be found in Appendix A of the request for information. Before I end this webcast, as a reminder for those interested in finding out more, this slide includes the published materials related to the request for information, which are available on our website. We have published a snapshot, which is a high-level and simplified summary of the main aspects of what is in the request for information. And then, the formal document that we publish is the request for information itself. We also have the optional response document, which is for those who do not have much experience of writing common letters. It provides the format to make it easier to go through the complete process. To support responses to the request for information, an online survey was published in April 2020 as an alternative form of outreach for stakeholders without the capacity or resources to submit a common letter. So, these are all published documents that are now available online. To assist stakeholders affected by the coronavirus pandemic, the deadline for submitting comments on the request for information is 27 October 2020. Due to the uncertainty and evolving nature of this crisis, we will continue to monitor the situation and assess whether to recommend further changes in the future. It is important we receive feedback on the request for information, as the feedback we are provided with is useful in helping us make sure we produce the best possible standard. Thank you to everyone listening. We look forward to talking with you again about the project soon.